Hey guys and girls, Nathan Birch here, just back out with the trusty whiteboard. Hopefully these videos don't get too boring, just in between meetings and phone calls and all that sort of stuff. Trying to make these quick videos to get as much content as I can out to you guys as quick as possible, with improvising what I've got. Something really funny, recently I was going back through some old videos that were on YouTube and clicking on the comments that everyone left. Thanks for the support for everyone over the years, even to my haters. And I just literally went through, today's our 11th birthday for the business. And I was going back through some videos to look at, the things that were said going back a couple of years ago with the haters comments and looking at now. I talked about hyperinflation beforehand. Some of the things that were said, well, you don't know what you're talking about, Nathan, you're a fucking scammer, you're off your fucking head, you should join the comedy festival, whatnot. Some of the stuff I say is pretty funny, predominantly to the haters. So yeah, it's just quite funny looking back at 2 years ago, talking about a GFD. When I talked about hyperinflation, I believe it was way before the time that I probably should have. As I was stacking lots of information out there to the community, that was way before its time as well. But yeah, got a lot of questions coming in from the community, and keep those questions coming. I want to try and educate you guys the best that I can, with as much knowledge as I can, with as much information as I can download as well. If you haven't already, email in my team at admin@binvested.com.au your phone number and your name, and I'll add you to Birch Feed for free, just so you can get a bit of understanding of some of the research that I do, so we can get up to speed. And there's about 2 years worth of data in there as well. So, hyperinflation. What is hyperinflation? Hyperinflation is when something costs $10, right? And then normal inflation would be like next year it's $10.50, and then $11, and then $12, and $13, and so on and so forth. But hyperinflation is when that $10 turns into 20, and then it turns into 30, and then that turns into 40, and I'm talking about from 9 a.m. in the morning to 4 o'clock in the arvo. That's what hyperinflation looks like. I'd be very happy to actually have a Facebook Live potentially, or an Instagram Live, or some sort of live stream, and get someone on to the video as well, because I've never been in a hyperinflation like many of you guys haven't either. But there is lots of countries around the world with the currencies that have been destroyed, and you can go and research currencies, and don't use the word money, but money, people refer to currencies as money, like dollars and whatnot. People do a bit of research into how the monetary system works, and I don't mean from any government or whatever, because they don't talk about this stuff. But basically, in a hyperinflation scenario, I could see 50 years worth of inflation happening in a short period of maybe 5 to 10 years. And I believe that we'll see that. When will we see that? Firstly, we need to see all of the money. We're in a deflationary period. Time of recording this, I think it's the 26th of March 2020. We're going to see a deflationary period for probably most of 2020 and maybe even most of 2021. We're going to see deflationary measures occur. Then we're going to see a lot of stimulus come out. And we're starting to see that. As of the time of filming this, we've got the Australian government giving out $200 billion worth of stimulus. The US government's given out $6 billion worth of stimulus, plus another 2, so it's really $8 billion, $1 trillion stimulus, sorry. I'm getting confused with billions and trillions, right? Like, these guys are just printing so much money. Basically, a hyperinflation occurs when the flow of money is constricted via deflation. They print out and stimulate the economy too much. People aren't spending that, they have to go print off more money. People aren't spending that, they have to go print off more money, to a point where people start spending it, and then it has a reverse effect, and there's too much money in the system and prices rise very quickly. So my view as an investor, and always has been, is to pay today's debt off with tomorrow's dollar. What do I mean by that? Is let's assume someone buys a property for 200K. 200K purchase price, and then they have a 160k loan on it. That 160k loan represents 80% LVR. Now let's assume that in 10 years time, we go down to 2030. One would normally think, okay, that property will double from 200,000 to 400,000. Which, how did it rise in value? Did it mean that lots of people wanted the property, etc.? No. What has happened is, if you go back and look at every time there's been a new market cycle where things have increased in value, we have, for example, I'm hoping we can get this on the camera, let's just assume that we're drawing a chart here, and we have 1990, we have 2000, 2010, and then we have 2020. Now, if we look at a house price, pretend this is in Sydney, let's take that away, and let's just say that this is just a rough chart, guys. We had 92, market fell down, then the market went back up, 2000 went down, market went back up, 2008, before that went down, went back up, just before here, and we don't know where it's going to go after that. Right? But in all these cycles, we had the recession of 92, we had Y2K, Y2K, and the GFC. I had this. Right? Was it the recession we had to have at the time? Was it the Y2K? If you notice how money flowed at these periods of time, there was a tightening and a tightening of the monetary policy. If we look at the Sydney market between 2005, let's say 2004, because I've been active in all these markets, well, not in the 92 one, of course. 2005, there was a contraction of money supply, and then in 2008, when we saw the GFC, they started printing more money, and then the prices are allowed to go up. So the question I ask, if someone has a mortgage of $1 million at the moment, right, and just think about it, right? Let's say northwestern Sydney, here in Sydney, let's use Kellyville for example. It's a suburb in Sydney, $1 million purchase price. Average incomes would be 80K. And each time what they've done, they've lowered interest rates here in 92, and better than what they did in 1992 is that they actually had, say a dad would go to work and then a mum would stay at home. What they did in 1992, they got the dad still working, but then they enslaved mum, and they gave childcare rebates so mum could go to work, and then mum and dad are both working to pay the mortgage, which is allowed for more servicing. Kids go to childcare, and there's a childcare rebate, and creates a whole new industry. In 2000, they started with a first homeowner grant. In 2008, they increased the first homeowner grant. They made it much easier for people to get money. As we got to 2016, 2020, they're giving you the deposit now for the property. So they gave you the deposit before, part of it. Now they're giving you the full deposit, and now in 2020, they're actually paying your mortgage for you because they're giving you mortgage holidays. But these are all things that never existed beforehand. Before 1990, you had to put down, there was no such thing as a 5% deposit. 5% deposit started around 2000s. In the early 1990s, you had to put down a 20% to 40% deposit. But no one remembers that, right? Quite conveniently, no one remembers that. But let's assume we've got two incomes, mum and dad, they're both enslaved, have to go to work. You've got 160K income, they've got two kids. How the fuck can mum and dad with that income go from $1 million house, how can that double? Well, quite easily, right? If you remove interest rates that were at 7.25% beforehand, down to 3%, that'll enable them to go from 500K in 2008 to 1 million, or say 750 in 2014, then down to 1.5%, which sort of blow off top phase, which allowed the properties to go to $1 million. So when a property goes up, what are we looking at now? 0.25%. Not even a 0.5%. It's 1/4% interest rate. If the interest rate was to go up again, right, and let's say it just goes from 0.25% to 0.5%, that's 100% growth, or the debt's doubled in cost. So as more people are pumping into this market, the interest rates are capped, they can't go up again. And I believe that it's going to head down to a -2% or a -3% is my target range. Remembering, I'm not a financial advisor, and financial advisors are generally fuckwits anyway. But anyway, looking at this perspective, they just there to sell you lots of junk, and they're using outdated, unknown monetary systems that they're taught at university. But that's how the things work. People feel that a 200 grand property is going to turn to 400 grand. People, like on this scenario of a 200 grand property, you're buying a property today, getting the debt, and then you're paying the debt off with tomorrow's dollar. So 2030, the money's losing its value, more money's circulating, and it can pay it off. And in 2040, that property could be worth from 400 grand to 800 grand, right? And we could change these dates from like 1990s to 2000s and whatnot. But here we are, where the property is now worth 800,000 and it's still got that loan at $160,000. Reason why I like investing in a property is that I can get today's debt and pay it off with tomorrow's dollar and watch that asset inflate in value. In a hyperinflation scenario, there will be issues, right? Which we're seeing at the moment. The government's stimulating the economy by giving different types of stimulus packages, injecting liquidity in the system. In 2016, when the market started to turn to shit, APRA came out and tightened lending policies. What they did is they basically did what an interest rate rise would normally do. But at this point, an interest rate at the RBA was 1.5%, and they couldn't increase it even to 2.5%, because it wouldn't have just killed property investors, it would have killed any type of business, because there's a thing called a bank bill swap rate, or a BBSR or a BBSW, which is basically the rate of what the bank gives, say 1.5%, and then they add 2% premium on top for a business. If that went up from 1.5% to 2.5%, that would in effect turn a 1.5 plus a 2% premium, which is 3.5%, into 2% premium on top of the 2.5%, which would be a 4.5%. So let's go 3.5, just so I don't lose you here. 4.5, meaning that businesses' expenses would have gone up 25%. Right? That's why we saw APRA come in, and that's the real reason why we saw it. And I realised it at the time, and that's why I tried to warn everybody. But we're at a point now, interest rates cannot rise. Interest rates have to go down because the whole financial system is corrupt. As they go down, things are going to keep increasing. That $1 million property can turn into a $2 million property if the interest rates went down by 50%, right? And think about it, overlay all this data of when the last boom happened, how the money behaved at that period of time, and you will see that that's why we've had growth. So can that income support a $2 million mortgage when it's 50% cheaper? Of course, because it's the same net outcome, but it just means that the asset has increased in value. So the money loses its value in the purchasing ability, and the asset appears to go up. So the houses aren't going up in value, the money's just losing its value. So in essence, you could sit here and see this property here go from $800 to $1.6 million over another decade. So it's 2040, then we've got 2050, where it goes to that value, 1.6, and you only owe 160. So the debt is very small comparison to the value. But at that period of time, what would a Big Mac meal cost? So in 2008 and 2020, Paddle Pop was 80 cents. In 2020, it's $2.40. So Paddle Pop's gone from 80 cents to $2.40. A Big Mac, a cheeseburger, you're getting the drill, right? A nice piece of meat, right? Big Mac, $5.50 or something. Now it's like 12 bucks. Cheeseburger, $4.50. Let's make up these numbers. Don't kill me if they're not right. And it's now $8 or $8.50 or something like that. So did the Big Mac get any better? Did the cheeseburger get better? Did the paddle pop get it better? No, right? If not, if anything, they got shitter. They got less quality and not as good. But the price went up. Why? Because the money is losing its value. And this is a phase that we're going to go into. You cannot print these levels of money and not have economic instability. In 2008, when we bowed ourselves out of the GFC, a lot of things were left unresolved. We've seen a big boom. We've seen house prices go up. Everyone's like, "It's in a bubble. It's in a bubble." No, the monetary system's in a bubble, and that's where we're at the moment in 2020, with a position where we're blaming some fucking Chinese guy eating a bat, where really the financial position that we had was very, very, we're bankrupt anyway as a country and as a nation and as a world. This is not an Australian problem, this is a global problem. So how do I see a hyperinflation panning out throughout 2020? We're not going to see a hyperinflation this year. I'd be very surprised, but nothing surprises me nowadays. They've said that the whole world stops and you're on martial law because some Asian ate a bat, apparently. But when will this occur? I believe that we're going to be printing so much money that somewhere between maybe 2024 to 2030, we're going to be printing so much money now to come out of the deflation. This is inflation. Deflation is when the cost of everything comes down, and we're in a deflationary phase at the moment. So we're going to be packing stimulus into the market, and as we're injecting this liquidity into the marketplace, making interest rates zero, making them negative, we're going to see this just be pouring fuel around the fire, not in the fire, just around the fire. And then at some point, the fire is going to reach it and it's going to implode. So my view could be 2022, it could be 2023, could be 2026, could be 2031, right? But I'm just giving my rough thoughts on when we could start seeing the hyperinflation occur. How will it occur? As I just said, stimulus. The stimulus that we're putting into the marketplace at the moment, the stimulus that we're putting in the market at the moment is going to try and avoid a crash, trying to avoid everything going bankrupt. And just think about it, guys. When was the last time in the history of the world that they go, don't worry about paying your mortgage. No one's going bankrupt. They bailed out the banks, right? In 2008, there was a couple of bad actors that did a couple of bad things, a couple of bad banks, a couple of bad corporations went bankrupt and insolvent. It caused a massive issue. That was based on $8.5 trillion worth of derivatives called CDOs, or mortgage-backed securities, which defaulted. This time, we have companies like Deutsche Bank, which has $50 trillion worth of derivatives on their own book. The world's awash of these things. If one of these things blow up, the whole system comes undone. What we saw in the GFC was only $8.5 trillion. This time, it's not about housing, it's not about anything. We've got everything that's been stimulated over the course of the last decade to avoid the inevitable back then. They've shown their hand, they're paying your fucking mortgage now. They're giving you free interest rate, they're giving you debt for no interest, right? That is the craziest thing I've ever done. How it's going to be caused is via all this stimulus. At some point, you have to pay up. So have you ever seen someone reckless that does all these bad things, they get away with it for a bit, they live a party lifestyle, next minute fucking gone. That's what's happening in the marketplace here. What causes it? For us to maintain our lifestyle, we're not producing like we used to. If you look at countries like China, China deserves to be wealthy. The reason why is it's actually producing. Here as a nation, we're not producing it. Most Western cultures aren't producing. If we look at the US, all they're producing is the dollars, which everybody has to buy off. But at one point, we will see the US dollar. When the US dollar folds, that's when we're going to see the rest of the currencies fold. So how to protect yourself? Look, this is something that I want to be very clear on. I've never been through a hyperinflation. It's something that I've got my views, my thoughts on how to protect myself. Basically, let's assume someone's on $50,000 a year, right? And a $50,000 income goes to $1 million, right? Everybody will be like, wow, I'm on $1 million a year, right? But when a Big Mac meal, Big Mac that cost 12 bucks now costs $250, right? The money has lost its value, so that $1 million still only buys the same lifestyle as that. Then the person will earn 2 million, and then 3 million, right? We get to a point where this money is just floating around. It's a wash. It actually has no purpose. That is the end of the currency system that we have, and it will end up with the death of the dollar. We'll need a new monetary system to use. And you know, this might sound like a lot of information, and it might sound terrible that we're going to lose the dollar. That's all we've known since we've been born and whatnot. Literally, in the last 2 millenniums, there's been over 10,000 currencies have all ended up losing all of their value, dying via a thing called a hyperinflation. The average currency, from memory, is 27 to 40. No, the average currency, fiat currency, is 27 years. 27 years is all that a dollar lasts for, on average. Any type of currency. The longest lasted 42 years, and on the 15th of August to 1971, the dollar was created. I know we saw it as a 1966, but you know, that shows that things have been manipulated like the Truman Show a long time before. So on the 15th of August this year, it will be 49 years, right? This is a Ponzi scheme that's gone on for a very long time. The whole world is indoctrinated to it. And when we see this currency die, it's going to be unlike anything we've ever seen beforehand. So yeah, very, very interesting times. So let's assume you buy that property with that's worth 200K. Let's assume, let's take these Big Mac meals off. So we buy a property for 200K. Someone earning 50K, we've got a 160K loan. Someone earning 50K would be a tenant in there. They're paying, say, $300 per week. That is $15,600 per annum. So they're paying, say, 30% roughly of their income, right? Let's say that their income goes from $50,000 to $1 million, and they're still paying 30%. That means that their rent is now $300,000 per year. $300,000 per year would pay out your debt. At that point, this house would be worth $10 million. I know it's hard to fathom, right? But go and talk to your grandparents or whoever that's older than you and ask them how much they paid for their property. I think my nan bought a property in Lane Cove for like $800 or $900 like 80 years ago. My parents bought a house at Parramatta, a house and land package for $13,000 going back like 60 years ago, 55 years ago, roughly. So yeah, looking at, if you had have asked my father that worked his whole life to pay off that $13,000, he put down a 50% deposit. So let's just draw that for a second as well. Back in the day, $13,000 for the purchase price of the property, 50% deposit, means that he's got a loan of $6,500. If you're on an income of $2,000 per annum, interest rates are like 10%. The repayment would be, the interest repayment on $6.5 grand at 10% is $650 per annum, plus a bit of principal, so they might pay, $200 off it, right? paying that mortgage down over 30 years. You look at that property now, it's worth $1.2 million. And the stamp duty would be worth double what they paid for it. And rent, that'd be like 4 months worth of rent would pay out that if you owned the whole amount cash. 50 years worth of inflation, I believe we'll see in a period of maybe 1 year, 2 year, 3 year, 4 year, 5 years, somewhere like that. So what I see happening is debt will become irrelevant with inflation, because you can pay today's debt off with tomorrow's rent. It's not the $15,000 per year that I'm looking at, it's the $300,000. Now these might be very far-fetched, this may not happen, but I believe we're heading for a hyperinflation. That's what I've been warning about, and that's something that is imperative at this period of time. So how does debt work? How can you benefit from it? You can pay the debt off using the rental income that after the income's been inflated away. Who will become wealthy out of this? Will it be some of that is over leveraged? People think that people are over leveraged or under leveraged, right? Someone who's got savings. The person that I believe will lose in this situation is a saver. Monetary policy is very different than what it used to be back in 1990, 2000, 2010, 2020, and it will be very different in 2030. That's why we're heading into a cashless society, in my opinion. Looking at debt will become a new asset. You can carry these items through the hyperinflation. That's why property is my favourite security to carry through. Other types of assets, like everything's going to be inflated away. This textile will be worth a lot more in the future. If you can just hold this for 5 years, there's people in Venezuela, Argentina that I've spoken to over the years, and they said, look, when I was looking at a shop, a chair would come out. Here's a chair, so home and wheelchair. The chair in the morning, that chair could be worth $100 right now, and then by the afternoon it's $150, and by tomorrow morning it's $200, and that's how hyperinflation works. Things go up very, very quickly. So any type of asset, if you can own something that you can trade, money will become worthless. People won't want to hold on to it, and assets will become, it could be shares, could be cryptocurrency, could be gold and silver. Most people out there talk about this stuff, talk about gold and silver, which I invest in, but I'm not, aligned to gold and silver specifically. I do have a lot of exposure in there. So out of this, who will win? This is a banker's game, the elite's game. If you can see how they play their game, I've spent a lot of time looking at how do the elite people play their game, how do they understand how debt works, how financial instrument works, and it's something that's really important for understanding how all this works. If you've still got time, what we're seeing at the moment, I believe, is a very big shock to the system, but it's a final nail in the coffin for the currency to die. The only way out of this, looking at some of the things that we're seeing as stimulus at the moment, potential universal basic income, stimulus payments, paying your mortgages, paying the tenants to pay the rent, paying incomes for people, paying businesses to keep open. This is a very, very interesting time that we live in. There's no more, bullets left in the barrel. So, looking at it, hyperinflation is something that I believe we're going to see occur over the course of the next decade. Not immediately. We're in a deflationary stage at the moment, and it's going to be very interesting to watch unfold. There will be people that will be hurt, people that I know, people that you know, people that we all know. So we shouldn't be too excited by it. It's not something to go and go, yeah, wow, we're going to have hyperinflation, everyone's going to get fucked. Right? It's not something like that, but it's something to be understanding. I believe that I'm prepared as much as I can be, and I think that everybody should do their little bit in their own lives to be able to protect themselves, for financial stability throughout these changing times, and very, very interesting times. So on that note, guys, thanks for watching. We'll catch up soon. Have a great day. Bye for now.